was really important. Prior to that, what happened was kind of every year, it would be like, when is it going to be approved? We have to go back and amend for it and things like that. So 2015 was a big year as part of the Protecting Americans from Tax Hikes, the PATH Act, it became permanent. One of the other things that was really important with the PATH Act was that it actually opened up the eligibility for startups. So now startups are eligible for payroll to offset a portion of their payroll tax. We'll actually talk about this a little bit more in depth later, but I wanted to make sure I mentioned it here when we were talking about the history. One of the interesting things about kind of the startup eligibility and using it to the R&D credit to be able to offset a portion of your payroll tax, actually on the floor now as part of some of the economic recovery acts that are floating around, they're actually looking at expanding this to 8 years. Right now, to be eligible as a startup, you have to be 5 years or less, but now they're looking at increasing this to 8 years, I think kind of with the pandemic and everything that's happening, trying to encourage as many companies to spend in the R&D realm as much as possible. So that's definitely something that's looking out, and it's kind of my job as the director of operations and the tax attorney working with EPSA to stay on top of those ever-changing guidance that we're getting from the IRS. So I'll turn it over to Rachel, and she'll kind of walk through what we call the 4-part test and how different companies qualify.
Yeah, and so want to walk you guys through the criteria for being eligible for the R&D tax credit. And really what you see here is the 4-part test that is outlined in the Internal Revenue Code in Section 41D, which is qualified research defined. And so the first part of this 4-part test is going to be the development, or so to speak, it has to be intended to identify whether activities conform to the purpose of the R&D tax credit. And ultimately, the purpose is to incentivize the development of newer, improved products, processes, formulas, inventions, softwares, or techniques. So those are all of the potential business components that can be done. And the results of this business component have to be aimed at improving the functionality, the performance, quality, or reliability of said product. Specifically for the food and beverage industries, most of the time, the business component is going to be a process or the product itself. But really what you see is the process that these types of companies are undertaking to actually, manufacture and develop, whatever, food product or a beverage product. And so we look at that entire process as they develop new strains or fermentations as the actual business component itself. The second part of the 4-part test is going to be the elimination of uncertainty. So these activities must be intended to eliminate technical uncertainty when developing or improving a product or process. It really needs to be related to the design of the product or process, the methodology of the product or process, achieving the goals, and the capability as well. So they have to be faced with some sort of uncertainty as to their development. For example, food and beverage companies, specifically face uncertainty regarding, what kind of barreling they're going to use for the wine, how long are they going to ferment it, what grape blend are they going to use, or, how much, wheat or barley or whatever it might be. Those are examples for wineries and breweries, obviously, but those are just some examples of the uncertainty that they face when they're developing, a new varietal or a new brew itself. The third part is going to be the biggest one, a process of experimentation. So the code defines a process of experimentation as, this first of all, the experimentation has to be aimed at eliminating that uncertainty. So during this process, various alternative approaches are evaluated, whether it's through simulation, trial and error, prototyping, or any other methods. Ultimately, aimed at meeting standards, quality standards. But, breweries or wineries, food and beverage, they conduct tests, trial and error processes. Does this meet quality standards? Is this even, is this going to work in looking at bottling techniques and so on and so forth throughout their process, and experimenting with these different techniques to develop, their food or beverage product. The fourth part is the easiest part. It's technological in nature, just meaning that the process of experimentation must rely on hard sciences such as engineering, physics, biology, chemistry, computer science. And it has to stay away from a soft science such as like social studies or surveys and et cetera. But for the food and beverage industry, it's typically relying on, the chemistry component, and that's typically their technical nature. But that's ultimately the 4-part test and how research is defined within the Internal Revenue Code. And so I'm going to hand it over to Ashley now to walk you through the expenses we can claim towards the R&D credit if they do meet this 4-part test.
Great. Thank you, Rachel. So kind of once we know that qualified activity is happening, we capture the expenses associated with those activities via the 4 main buckets of cost. Typically working with brewery, distilleries, and kind of clients in the food and beverage industry, we see 3 of the buckets here captured, not all 4, but I want to make sure we're doing our due diligence and educating, as this is, you guys aren't getting credit for the course. So I wanted to make sure we educated appropriately. So there are 4 buckets. So the first one you'll see is, I would say 99% of our clients in any industry have the first bucket of costs, which would be wages. So that's your employee costs. So the great thing about the R&D credit is that there are 3 levels of activity that we can capture when it comes to employee wages. So that would be employees directly engaged in R&D activities, which is pretty common sense. But then you can also take high-level executives directly supervising those R&D activities, and then support staff directly supporting those R&D activities. So in breweries and the food and beverage industry in general, obviously the employees directly engaged, we've got your brewmaster, your winemaker, those are the individuals we typically see at that level. When it comes to the supervision level, we see, managers or directors or individuals who are directly supervising the brewmaster and the winemaker. And then at the direct support level, we've got quality assurance, lab tech, like Rachel was mentioning earlier, the individuals who are kind of testing that the brew or whatever it is that's being made to make sure that it's meeting those quality standards, that you can actually sell it to your customers, those kinds of things, to make sure that it can actually go out for commercial production. We can take those individuals to at that support staff level. The next bucket of costs you see here are contractors or 1099s, just kind of depends on like how the company refers to them. So this would be any individual that's performing the activities that we just discussed, but they're paid on a 1099 or through a third-party service. So, a third party performing qualified activities, obviously, that would be a contractor. So we can take those activities in addition to testing services. So sometimes that the quality assurance testing that Rachel talked about, kind of making sure that it meets the standards that it needs to be sold. Ultimately, that can be that a lot of times is, contracted out. So you can take those activities as well. One of the interesting things about working or qualifying contractors is that while you can take up to 100% of an employee's wage, you can't do the same thing with contractors. I think just kind of when the credit was enacted, they knew that obviously contractors, you're not paying their benefits, you're not paying any of their employee Social Security tax or anything like that. So you can only take up to 65% of any amount that's paid to a contractor. Obviously, you need to figure out a percentage of time they spent on R&D activities, but it would be capped at 65% of the amount paid to those individuals. Next, you'll see supplies used for research. So this is raw materials used while conducting qualified research, and not general and administrative like pens and pencils and paper and things like that. That obviously cannot be included. I would say this is definitely an underutilized category. I think it can be kind of time consuming to capture and understand what can be included and what can't be included, especially in the brewing and distilling industries and food and beverage as a whole, because you're making new batches and you're running test batches, but you're also making stuff that you've made before, and it's the exact same recipe, and your customers like it, so you just kind of keep making the same thing. Obviously, you can't capture the supplies associated with that. So it's, especially sometimes with our smaller operations, just getting in there and getting their general ledger or job costing, whatever they may have, and figuring out how much of these supply costs, they bought, 40 pounds of hops this month, how much of that went to new batches and how much went to batches that that they're just continuing to run and they know exactly what to do. So working with our clients to be able to do an estimate is definitely important. And I think that's why a lot of our clients haven't claimed it in the past, because they just don't know what to do with it. They have this lump sum that's been used for everything. They just don't know how to break it down. And it is important that you make sure that you're tying it directly to the R&D efforts when it comes to audits and things like that. Just kind of in my history, I've handled quite a few audits at this point. You know, in my experience, and supplies are definitely something that the IRS looks at, but if you've got the correct documentation, it's just kind of checking the box and they move on to the next thing. So it's definitely important to make sure that you've got the correct documentation. The fourth bucket of costs, like I mentioned, it doesn't really happen too much with our brewery and distillery clients, but wanted to make sure we mention it just in case you have other clients. In the technology field is typically where we see this. So it's actually written in section 41B of the Internal Revenue Code as rental or lease of computers. That's been interpreted recently to mean cloud hosting. So if you've everyone's heard of the cloud at this point, Amazon Web Services, IBM Cloud, Microsoft Azure, those are kind of the three big ones. Google's got one too. There's hundreds of these companies now floating around, especially with remote work. But if you can tie R&D efforts to time or expenses related to the cloud, you can also take an estimated percentage of that as well. So wanted to make sure we walk through all four buckets of costs, even though typically we see three, but I know there are some CPAs here who don't just have brewery and distillery clients. So wanted to make sure we mention that as well. Any questions? Okay. So next, wanted to walk through just kind of at a high level, kind of some examples of some industry qualification and job titles and job functions. So these aren't all just food and beverage and brewery clients, but we figured we should touch on some things that can kind of interrelate to that industry. So the first thing that you'll see here is software and technology. I have a couple, you know, I've worked with some brewery clients in the past, and they've developed an app in-house for their customers to be able to order their beer sitting from their table, and they've done that themselves. So, you know, it does happen. So I want to make sure we talked about it. So obviously software development, mobile and web application development, cloud computing development, and AI technology, that's all activities that qualify. And then job functions such as, you know, developer, engineer, designers. Those are some example job titles for software and technology, either industry or software and technology functions.
Great. And then I was going to go over here with you guys food and beverage and manufacturing industry qualification. So they kind of go hand in hand with each other. As you know, food and beverage, you're technically, you know, manufacturing a product or, you know, a brew or a wine. But specifically for food and beverage, some of the qualifying activities, as you can see here, is going to be, you know, the development of unique fermentation methods, new or improved production methods as a whole. And of course, those pilot and test batches included in those new production methods. So, and that's a good example of supply expenditures that we can capture are all of the supplies that go into developing these pilot and test batches until they get it right. And then some other activities are going to include the implementation of new or improved bottling and packaging methods, as this is pretty important depending on, you know, the chemical compounds of the actual, you know, product that's going into the bottles and, you know, the quality of them as well for shipping and so on and so forth. Also, we have, of course, the experimentation of alternative yeast strains or grape varietals for a winery, for example. So those are just a few example activities on the food and beverage side, and some qualifying job functions are going to include, of course, like a winemaker, a brewmaster, the actual one who's testing and experimenting with the different varietals or yeast strains, those individuals who are directly doing R&D. And then we have production managers who may be directly supervising some of the R&D activities going on. And then quality assurance individuals who, you know, are maybe conducting some of the tests themselves and really supporting the R&D efforts. We then have vineyard manager, cellar manager, lab manager on the supervision side of things that, you know, oversee some of the R&D and maybe offer technical suggestions to the actual strains themselves. And then that gets us here to manufacturing. Just to educate you guys briefly, since I know you do have other industries that you do work with and types of clients, but for manufacturing, really the qualifying activities is going to be around the design, development, and engineering of the product that they are trying to make or produce for their client. So it's going to be the new or improved product design, prototype development and testing, sometimes tool and die design, engineering and testing. And then, of course, the programming that has to go into, programming the machines that are manufacturing the products, that time is qualified as well, because most of the programs are unique and specific to each new product. We also have the development of new or improved manufacturing processes, which is kind of how it interplays with food and beverages. Those internal process improvements going on throughout the manufacturing plant or changes to the shop floor to make things more efficient are all going to be qualified activities as well. Some of the job functions on the manufacturing side is going to be your engineers, your technicians supporting the R&D, your tool and die makers, production managers, quality assurance, very similar to food and beverage, just kind of a little bit more technical depending on what type of manufacturing firm it is. And then that gets us to the next slide here, which is going to be regarding debunking misconceptions surrounding research and development. So a lot of the times companies or even sometimes CPAs run into these questions, and they're kind of myths surrounding R&D that make individuals kind of shy away and think that they might not qualify. But the first misconception is going to be that companies must be developing something new to the world to take advantage of the R&D tax credit. That is actually false. So it really just needs to be new to the taxpayer or the one doing the R&D itself. And that was actually outlined in what is known as the discovery rule, which officially eliminated the need for it to be new to the world in the early 2000s. So thank you, discovery rule. It only needs to be new to the taxpayer for R&D credits to be claimed. The second misconception is going to be that sometimes companies cannot claim the credit if they're being paid for the work that they're doing. That's also false. So whether you're being paid or not paid, it doesn't, matter. But if you are being paid, we do have to look at the payment terms, as there is an exclusion outlined in the Internal Revenue Code known as the funded exclusion. But it ultimately doesn't hinge on whether the taxpayer is paid or not at the end of the day. It really just looks more so at how they're paid. And that's why throughout our process that here at EPSA that me and Ashley undertake, a big part is gathering contract agreements, especially in our calculation and qualification phase, to ensure that all of the fee terms, as well as the rights language within those contracts, are favorable towards the R&D credit. Because ultimately, we just have to look and make sure they're undertaking economic risk, as well as maintaining the rights to the research. But all in all, it doesn't matter if the taxpayer is being paid or not. And the third misconception is going to be the company must be profitable to use the R&D tax credits. That is actually false. I mean, it is great if they are paying taxes, because that's really what the R&D credit was intended for. However, the credit can be used to offset payroll tax. So as Ashley was mentioning earlier, well, the Social Security portion of that payroll tax, to be specific, if they are a startup company where they've been in business for less than 5 years and have less than $5 million in gross receipts, then they can use these R&D credits to actually offset their payroll tax if they don't have the actual tax liability on the corporate side. So those are just some few misconceptions we want to go over, but I'm going to hand it over to Ashley now to talk you guys through how the credits can be utilized.
Thanks, Rachel. And that payroll tax offset kind of flows right into utilization. So as some of you, if you're familiar with the R&D credit, the credits can be carried forward for up to 20 years. So the way that the credit works is you have to attempt to use it in the credit the year the credit is generated, excuse me, and then it's carried back 1 year, and then it can be carried forward for up to 20 years. So Obviously, like Rachel mentioned, it's ideal if they're paying taxes, not obviously ideal. They don't want, no one wants to pay taxes, but if for the R&D credit purposes, if they're paying taxes, that's what we want it, to offset. But I have worked with some companies before, and it can be common in this industry as well, that the credits can be used to offset tax related to the sale of the business later on. So, they can carry it as an asset on the company's balance sheet, especially if they're a C corporation, and then use it to offset, the sale of a business later on. Obviously, this must be evaluated on a case-by-case basis, and the attorney in me needs to make sure I give a disclaimer that can't always be the case. But it just depends on the most appropriate utilization strategy. That's why we work pretty hand in hand with our CPA partners. We don't make these decisions in a vacuum for clients, and we don't want you guys to do that either. So we have a conversation with the client and our CPA partner to make sure that it makes sense for the client. Ultimately, they're going to be paying you all to amend tax returns if we're amending, and they're going to be paying us. To calculate the credit. We want to make sure that they can use it, but maybe they know in 5 years they're trying to exit it and they're going to have a big tax bill at the end of the day. Maybe it does make sense to generate these credits to use to offset that future tax. The other way, like Rachel was mentioning, is offsetting payroll tax. So this was, like I mentioned, something with the PATH Act that was enacted. It can be used to offset the employer portion of the Social Security tax liability for all employees, not just the employees who are performing R&D activities, which is pretty nice. The company has to be 5 years old or less and has to have less than $5 million in gross receipts. So 5 years old or less just matters kind of when they filed the first tax return is typically what we look at. But if it's a continuation of business, we have to go with the first year of the original business. They are looking at expanding this a bit, but as of right now, it is 5 years old or less. There are some nuances to this as well. It is a maximum of $250,000 per year. With food and beverage clients, we don't typically find that they max out the 250, but you never know, and sometimes that does happen. So any unused credit can be carried forward to offset future payroll tax or income tax, depending on the financial situation of the company. And again, this is another situation where we work with the CPA and payroll provider. It's not just, we're going to go over 6765 here in a minute where you file the R&D credit, but it's not just as simple as filing the form 6765. There's also some payroll forms that need to be filed to make sure that you're offsetting the payroll tax correctly. So we work with CPAs and payroll providers sometimes to make sure that gets done. The other thing is net operating losses can kind of play into utilization. Depending on the tax-paying position of the company, it may be possible to go back more than the 3 years that you normally can to generate an R&D credit to be carried forward. So typically with the R&D tax credit, if you're amending a tax return, you can go back 3 years from the date the tax return was filed. So we're looking at now kind of rolling into 2022, we can go back and amend 2018 and forward tax returns. But if they were in losses and you have to really verify that they were in losses, different things can impact that. So we work with the CPA in this situation as well. But if they were in losses, you can sometimes go back more than 3 years and then generate that credit to be carried forward. But like I mentioned, it is pretty specific to each entity would need to be evaluated. And here's a form 6765. This is just kind of I know this is kind of small, but just to walk everyone through it, as of right now, this is the only form that's required. This is the only thing that's required when you're filing the R&D tax credit is this form 6765. Starting I think the official date right now is January 10th, 2022, but they're going back and forth on this. They're saying that they're requesting comments and things like that. But the Office of General Counsel for the IRS did just recently issue a memorandum saying that a report is now going to be required for amended returns. They haven't said if it's going to impact original, but as of right now, they're just saying amended. So in addition to this form, starting in January of next year, a report will be required, and we'll talk about that here in a minute. But as of right now, it's just this form. So you'll see on the top is the regular credit. That Rachel's going to talk here in a minute about the different base methodologies. There are 2 base methodologies when calculating the credit, and you typically just pick the best one if you have the information to calculate both. So you just fill out one of these areas, either section A or section B, depending on the credit that you're deriving. C is kind of more informational. And then section D, you fill out if you are using it to offset that payroll tax. Offsetting payroll tax, I should say, does need to be filed on an amended or on an original return, excuse me. You can't go back and amend for that. You can go back and amend for an R&D credit, but then you can't use that to offset payroll tax. So basically you'll have either section A or section B filled out. I've seen CPAs fill out section C, but you don't have to. It just kind of depends on the situation and what's flowing through. And then section D will also need to be filled out if you are claiming it to offset a portion of your payroll tax. But this is what we provide to our clients now. Like I mentioned, starting next year at some point, if it's in January or if it's at a later date. If we're amending any years, we would also include a report as required. And then next, I did want to go over some state R&D credit. So as you may be familiar with, a lot of the states do offer R&D tax credits, but the requirements vary pretty dramatically. So there are some states that have an application that are due. So you'll see New Hampshire there, their application is due by June 30th, following the tax year during which the R&D occurred. Very specific about that. So there are some states that require an application. New Hampshire is one of them. Pennsylvania is another one. Virginia is another one. There are some states that require it to be a certain entity type. I don't think Maine and New Hampshire and Vermont don't have that requirement, but some states do require that you be a C Corp, or some states require that you be a pass-through entity. So you always want to make sure you double check that. It's kind of mine and Rachel's job to make sure we're staying on top of that and making sure we're meeting those requirements, but that's something to look out for. You'll see here with Maine, kind of it's based on a percentage of the federal R&D credit. That's another requirement that varies state by state. So Maine and Vermont are both ones that you have to file the federal credit to be eligible. That's actually very rare, but I guess in y'all's neck of the woods, it's common. So Maine and Vermont both need to have the federal credit to be eligible. And then you'll see there the main credit, the actual calculation of itself, and then how, what percentage of the tax liability you can offset there in Maine, but all entity types are eligible in Maine. With New Hampshire, as of right now, it's from our understanding and speaking with people in New Hampshire, it's only eligible for manufacturing R&D wage expenses, which is very specific. Hopefully they expand that because I know there's a lot of companies in New Hampshire that are doing things other than manufacturing, and they're definitely doing R&D. But as of right now, kind of from our understanding and talking with the New Hampshire Revenue Department, that's what they do. Also, the credit can't exceed $50,000, and they cannot also be eligible for the ERZTC. And they are an application state, so that application is due by June 30th, and it can be carried forward up to 5 years. This is another interesting fact about different states versus, some you can carry forward 5 years, some you can carry forward 20 years, some is refundable. So, if you generate a credit that's greater than your tax liability, the Department of Revenue will actually write you a check. Iowa and Virginia are the two big states that stand out to me that are refundable. And then for Vermont, just a few things, like I mentioned, you do have to claim the federal credit. It's a pretty generous credit, though. It is 27% of the federal credit claimed attributable to Vermont activities. So if all of the activities are happening in Vermont, then you get to take 27% of that. If not, you have to figure out a portion of the activities that are happening in Vermont, and then you take 27% of that. And the qualification requirements in terms of 4-part test is it's the same thing that the federal requirements are that Rachel just walked you guys through. So it's the same thing. And this in Vermont, it can be carried forward up to 10 years. So those are just a few examples of some states. Shameless plug for our website. We do have all of the states highlighted and the different requirements per state on our website. And then we wanted to go over with you all some ways to optimize the credit. I'm going to kick it over to Rachel, and she'll walk you through some examples of clients that we've worked with in the past and some different ways that you can optimize R&D credits if you're already calculating it for yourself, for your own business, or for clients you work with.
Yep. And so as Ashley mentioned, here is one example that we wanted to share with you, just a case study as to really how we optimized this client's R&D tax credit. They were specifically a software development and manufacturing firm, and they had previously claimed the credit. However, they did leave some expenditures out on the table. And so one way that we are able to optimize the R&D tax credit, which is typically the first thing that we look at, is going to be investigating all of the relevant, buckets of cost and R&D expenses. So wages a lot of time are typically the main expenditure captured, but we take a deeper dive and look to see, hey, is there individuals who are directly supporting those R&D wages or directly supervising them, because those are typically left out and they only claim the ones or only claimed those directly engaged. So specifically for this example, we were able to capture direct support through a few customer support individuals where these employees were really supporting the R&D activities through determining improvements that can be made to the product. We also were able to capture wage expenses of the CEO and COO as they were directly supervising the product development process and making suggestions for product improvements along the way. So that's kind of how we optimized it from a wage expenditure standpoint. We also were able to further capture contractor costs. So similar approach as to determining the qualification for contractors as we look at wages, determining if the contractor is supporting R&D, directly doing R&D, so on and so forth. And then we also evaluate the fee terms of those, contractor agreements. In this example, we were able to include that as a bucket of costs where it wasn't previously included. Additionally, this example case study, they were not capturing supply expenses, which I know Ashley had mentioned. It's typically something that is left out on the table. And so this would be a great example of that. But they weren't capturing any, prototype costs or testing costs. So we were able to take a deeper dive and estimate, how much of their, supplies were used in this prototype development and testing expenditures and apply that to their R&D tax credits. This company had about 23 employees, and we were able to increase their credit by $25,000 through evaluating and investigating all of the expenditures.
And one of the great things too about this company, they were pre-profit, like it mentions here, and they were within their first 5 years. So we were actually able to, the increase of 25,000 actually was able to be additional credit that they could use to offset their employer portion of their Social Security tax liability, which is a huge deal for these startup companies that are doing some pretty amazing things. So they were very excited. They said they were going to pop some champagne when we hung up because they were so excited that was, money back in their pockets. And for these startup companies, which I'm sure you guys are familiar with, especially in the brewery industry, these guys are just, pursuing their dream, and to put some money back in their pockets is probably my favorite part of what we do.
Great. And so another way that we have, as an example, optimized a client's R&D tax credit is through also investigating the base methodologies. So there are two ways of, looking and calculating R&D tax credits. One is going to be the alternative simplified credit, and then one is going to be the regular credit-based methodology. But kind of to circle back, this client specifically had about 14 employees, $2 million in revenue. They were an engineering firm and they had never claimed the credit before. But as a part of our process and in our analysis, Ashley and I always look into evaluating both bases and both calculations, ultimately to see which one's going to be more beneficial. And so the ASC base period or alternative simplified credit is going to look at the prior 3-year qualified expenses. And it takes 14% of those qualified expenses for the taxable year as it exceeds 50% of the average QREs for the prior 3 years. So the ASC base only looks at qualified expenditures and it only goes back to prior 3 years. The regular credit, however, is based on when the company started. So there is a startup regular base and then an 80s regular base if they started in the 1980s. This specific case study example, it was a startup base period because the client started in 2006. So we gathered some profit and loss statements and some financial documentation for that time to incorporate that into the regular base calculation and determine what qualified expenditures, how much qualified expenditures did they have in that regular base period and factor that in. And then once we identified and finalized building out the regular base and ASC base, we got to look at both of them and determine the regular was more beneficial. It actually was more beneficial by $10,000 in R&D tax credit. So some additional a good additional amount just from looking at 2 different calculation methods. So that's another way that you can definitely optimize the R&D tax credits. And we look at that for all of our clients. And one thing to note is so the first time we're engaging with the client, it's a little bit of work building out the regular base. And of course, we have to build out the ASC base as well. However, once we do it, it's done. So we follow up, we conduct it the first year, we're doing R&D tax credits for them, we're calculating them for them. And then every follow-up year, it's already built out and it's not a process you have to go through every single year if they continue to work with us.
And I would add to, a lot of times we see with our brewery clients that the company who owns the brewery or the individuals who own the brewery also own other businesses. So that's kind of like a level up from this training that we're talking about today, but that's definitely something to consider when you're talking about building out the regular base. Is the activities, it's going to be activities for all of the controlled group entities. So you've got to make sure, I would say like half of my brewery clients in the past have owned other entities. So you've got to make sure that you're doing your due diligence, and we work with our CPAs to make sure we're getting all of the relevant tax returns to make sure we're calculating the credit for the correct entity and the expenses are going to the right places. Because the base methodology is like Rachel just walked you through the calculation, it is pretty important. And it can have a pretty dramatic effect if you're able to build out that regular base, because obviously in the first couple of years, maybe they're just getting going. But the last 3 years have been really big for them. So we like to do the regular credit as much as we can, because it can be more advantageous. We've had situations where it's not. We've worked with a couple of clients where they've claimed it on their own. And then we try to go back in and optimize it. And when you're going back in to optimize, you have to follow the same base methodology that they used when they calculated it themselves if you're amending that same return. And we were locked into regular, and I think they missed out on like $200,000 because they were claimed a credit at the regular methodology, whereas had they claimed ASC, it would have been higher. So I know that's kind of a little bit more technical than we've been going today, but I just wanted to make sure that we did talk about that, because this can make a pretty dramatic difference either way. Okay. So I wanted to take a few minutes to talk about our process. I know we have, we open this up to some, breweries and distilleries directly. And I thought it would be helpful to talk through kind of how we conduct our analysis. So if you're going to do it internally, kind of the steps that need to be taken. Obviously, this is our process, so it can change depending on kind of what situation you're in. But I wanted to make sure we walked you guys through this so you had an understanding of kind of what we do and what would be needed if you were all to calculate it on your own or with your client. So some of it may be relevant and some of it won't. Figured we could talk through it. So the first is obviously kind of educating and understanding. Do we think we're going to qualify is kind of the first step of the analysis. What do we think is going to be here? Can we even use the R&D credit? We spent some time talking about utilization. If you can't use the R&D credit and you're not a startup, maybe it doesn't make sense. But making sure that you assess that at the beginning before you actually dive in and go through all this work to calculate the credit. For us, that's normally handled with our business development team, and sometimes Rachel and I get involved in that as well. And then we have a kickoff. But if you're just doing it internally, then obviously you just meet with the appropriate teams and kind of talk about what's the timeline and things like that. So at our kickoff meeting, we talk about timeline. What do they have any expectations of what the credits are going to be is always something we like to know up front. If a client's expecting $100,000 and we expect it's going to be 20, let's have a frank conversation at the front end to make sure this is going to be worth it for everyone. We also talk about the documents that are going to need to be gathered. So obviously, if we're talking about wages, we're going to need W-2s. Contractors, we're going to need the 1099s. Supply cost, if we're going to capture that, we'll need things like job costing or, WIP reports, or however, sometimes it's just tracked on a piece of paper. So you need to understand kind of what kind of documents you're going to need to gather and what different departments are you going to get them from. If it's just a couple of employees, maybe you don't have an admin person who's going to gather all the documents for you. So making sure you have an understanding of the documents that you need and who you're going to get them from. And then what we do on our end after we gather the documents is we do an initial evaluation of the qualified research expenses. So we conduct a call with kind of the main technical point of contact at the company, and just to get an understanding of a high level understanding of what's happening. And we give some allocation percentages of the estimated time that we think the employees are spending on R&D efforts. If there's contractors, the supply costs, we do an estimate there if we can, and cloud hosting, if there's an estimate there, we do that as well. And then we give an estimate at that point. And this might be something that you all want to do too, if you want to implement it internally, just an estimate before you do that deeper dive of, okay, so we had the initial conversation, we think it may be 20K, now looking at the expenses, maybe it's 30K. Do we think this is something we want to do now? You make that decision. For us, we discuss this with the client and the CPA, typically 2 to 4 weeks after we kick it off. And then, our clients can say, hey, this is going to be worth it. Let's move on. Hey, this isn't going to be worth it now. Let's readjust or reassess in a couple of years. But if they decide to not move forward, we don't charge them. So that's kind of something unique to our process. But it may be something that you all want to implement if you're doing it internally and in-house, or just because you do have to do a deeper dive in what we call our second phase, so making sure that it makes sense and you have time, people have time to dedicate to it. So if our clients make the decision to move forward, we move on to the qualification and calculation phase. That typically takes about 4 to 8 weeks. For us, it depends on how quickly we can get that documentation and the interviews scheduled, which I'm sure you guys may have the same issue that we do. Sometimes it doesn't happen as quickly as we would like. When it comes to the qualification in the second phase, what's important to do, and you need to make sure you're doing this if you're calculating it for your own clients or in-house, you have to identify your project list. So that would be any project that you think R&D occurred from the study period and looking at your base period that Rachel just walked you through. So whether you're doing the 3-year look back or the regular base and going further back, you need to understand the projects that occurred during those years, and then you need to interview on those projects. So you need to make sure that each project meets the 4-part test, and if they don't, how are you going to account for that? So we conduct qualification interviews with clients, and sometimes it's the same person that we did the initial interviews with. Sometimes it's different. Sometimes it's 4 different people. It just kind of depends. So you need to be prepared for that as well if you're going to do it internally. Gathering project documentation is pretty important here to substantiate the credit. There is no specific documentation requirement when it comes to the R&D credit. Like I mentioned, now they are requiring a report, but it's not specific. It's just, they're just generally saying report, which is very IRS-like. But there's no specific documentation requirement. You just need to keep, the records that you do in the normal course of business. So making sure that you have some sort of project documentation to back up the activities that are, qualified. Not all clients are going to have documentation. And like I mentioned, because there's no specific requirement, that's okay. One of the things we do is we work with clients to figure out, if you don't have documents, what can we put in place so you do have documents in the unlikely event of an audit. And then contract review is another thing we do with the qualification stage that you will need to do as well. If your client or your company is doing work on behalf of another company, so like somebody's paying you to do work, you do have to review contracts like Rachel walked you through. It's called a funding analysis, kind of, since if EPSAs, if we are doing the work, we're performing the R&D analysis, as the attorney, I'm the one who takes a look at the contracts to make sure it complies with the case law and the code and the regulations. But this is very important because if the IRS comes in and you didn't do a contract review when you needed to, or you included expenses for contracts that were deemed funded because you didn't bear the economic risk, the IRS will have a field day. So it's important to make sure that you're complying with the contract review. And I would say this is a lot of times when we're working with clients who have optimized the credit in the past, sometimes it's not all roses and sunshine, like Rachel just mentioned, and walk through, like, we found additional benefits. Sometimes we find less, but it's because they didn't do the contract review that they needed to do. So this is definitely something to keep an eye out for. And then when it comes to the calculation, we have a calculation model built. Obviously, you'd have to, calculate it in Excel or however you would calculate the credit to make sure that you're, complying with the actual calculation that's set forth in Section 41 of the Internal Revenue Code. So we calculate the qualified research expenses, determine the final credits at the federal level and at the state level. So like I mentioned, if we're conducting research, or if we're conducting a study and they have activities happening in a different state, we can include that as well. I'd say also, I don't think I mentioned this previously, but this is becoming more common with remote work, that, if you have a company in Maine, but now everyone's going remote and you can hire employees in California. Most states are activities-based states, so you may be eligible to claim a California state credit, for example. So that's definitely something to look into. So We will provide a form 6765, and that's all if you're doing it internally, that's all you need right now. Like I mentioned, there is a reporting requirement that's supposed to be coming out in 2022. So if that's the case, then you will be required to file the report with your form 6765. But as of right now, it's just the form that needs to be filed. What we do is we conduct a final credits call. I'd recommend a version of a final credits call. You don't obviously need to set up a formal call, but walking all of the stakeholders through the process so they can understand kind of how you got there, and just explaining the different expenses. This is also a good opportunity to talk about like, hey, this contract didn't qualify, so these expenses had to be removed. If we can change these contracts, great. Or we didn't have time tracking, so we think we left some dollars on the table when it came to the employee expenses. If we implement it, we think the credit can increase this amount. So it's definitely something I would recommend if you are doing, if you're working with a client or you're calculating the credit for your own business. That's definitely, you know, a good time for reflection, if you will. So for us, it does take about 4 to 8 weeks. Like I mentioned, it just kind of depends on the documentation and scheduling of things. And then we hand that over to the client and our CPA partner, and they file the credits at that point. At that point, the heavy lifting's done from the client and the CPA. It's on to us. So we draft up a pretty in-depth technical report. Rachel and I both have some extensive experience with audits. So we have drafted our reports at least to make sure that it, you know, anything that the IRS, if in the unlikely event of an audit, and you know, anything that the IRS would want or question or need, it's set forth in that report. Otherwise, it's for everyone's reading. It's a little light reading. I think our average report is 60 pages or so. It walks through the analysis, who we interviewed, what expenses we included, what expenses we excluded, all the different documents that we looked at, how every project meets the 4-part test. That's all kind of laid out in layman's terms in that report. And that is normally given to clients like 4 to 6 weeks after we file the credit. But you guys all know how tax season goes. So if we're filing a bunch of credits around tax season, sometimes it takes a little longer than 4 to 6 weeks, but that's kind of the average time. And then just kind of a little bit about us. You know, we obviously couldn't have delivered those credits we just spoke about without the help of our CPA partners. We do specialize in the R&D tax credit, and we have a team of experts to make sure we can back up every dollar we find for our clients. If you are interested in partnering with us, I know we have some CPAs on the line, or you know, you yourself could be a potential client. Feel free to reach out to myself or Rachel. We'd love to just even get an idea of who you are, and before, you know, we don't have to sign any contracts or do anything like that. Just talk about it, and is it something that your company would be eligible for? The next slide kind of highlights some of the companies we've worked with in the past across the world. We do work with mom and pop shops all the way up to kind of Revlon, Clarins, and some big names there. But, you know, we work with small to medium sized companies, you know, just a handful of employees all the way up, you know, to a couple thousand. That being said, that's all we had today for the presentation. I did want to take some time to make sure we address any questions if anybody had any.
Before anyone jumps in, Ashley, I have to correct you. That was not just all when you defined that. You packed a lot of information into this presentation. So thank you very much to you and Rachel. And I would reiterate, you guys that are on this call have an incredible resource here. So if you have any questions, please jump in. That's the advantage of being in a small group. So it's small enough that you don't need to go into the chat. Just please turn on your camera and your microphone and ask your question.
Thank you, Trish.
Actually, I think you might have, can you hear me okay? This is David.
Yeah.
Yeah, actually, I think Ashley might have covered this on one of the slides when you were talking about the various expenses. You know, I think you went to the 4 quadrants. Mm-hmm. What in the food and beverage industry, or maybe, you know, the brewery industry, what do you guys see as maybe the common expenses that are most often missed or most often exploited? And that's probably not the right word, but, you know, maximized. I mean, you gave a couple of examples, but I just thought some of the practical things that you see that, hey, these are things that we could have done better with, or boy, there's a real opportunity here.
Yeah, I would say kind of in my experience, and Rachel can talk about hers as well, I would say definitely that direct supervision So obviously like the brewmaster is going to qualify, everyone kind of understands that, but I would say the supervision and support activities. So if you have kind of a general manager of the brewery, he may not be the brewmaster and he's not spending all of his time on that, but he's helping with the taste testing. A lot of that time that can sometimes be left on the table. Also, I'm seeing a lot more brew pubs pop up, especially here in Texas. I'm not sure how it is in Maine and New Hampshire, but sometimes just employees. So you have like waitresses who are helping, with the taste testing and testing for the quality before it actually goes to commercial production is what we call it for the R&D purposes. So sometimes that time can be included as well if they're part of the formal testing process. So I would say the supervision and the support, but those specific activities. And then the supply costs as well. I think sometimes when it comes to supply costs, people are scared off. They're like, well, that's can be overwhelming. Like I mentioned, you spend so much money on hops and barley and everything that goes into making a beer that you're like, well, I make this beer every day. Like this isn't qualified. So I think figuring out how much you can apportion to the new and kind of like the test batches versus the kind of, the ones that are kind of already up and running. I think that is definitely a bucket of cost that's left on the table as well. And in terms of exploiting, I would say supply costs the other way. I see either no supply costs or like everything is included. And like that, the IRS isn't gonna like that either. So I think it's just making sure that you can tie the supply costs you're capturing towards the correct expenses.
Sure, thank you.
Mm-hmm.
Anybody else have a question before we wrap up? I don't see any. I will plan to share Ashley and Rachel's contact information with those of you who had registered for this course, so that if you choose to follow up or have additional questions, I hope I'm speaking accurately, Rachel and Ashley, that you would be happy to address those.
Yes.
Of course. And feel free to connect with us on LinkedIn. Where Rachel and I are constantly posting like articles and things like that, linking to our website. We have what we call a one-pager on our website that has kind of a detailed list of information of what qualifies for the food and beverage industry, and kind of breweries fall into that, obviously. So feel free to check that out as well. But like Trish mentioned, love to kind of connect with you all and talk about kind of, what you've got going on.
Thank you so much, Ashley and Rachel and EPSA. You were a phenomenal team and provided us with lots of great information. So really appreciate your time this afternoon. Thank you to the MECPA and New Hampshire Society of CPA members who attended. Your time is appreciated as well. So thank you. And I hope everyone has a great evening and a good holiday season.
Thank you. You too.
Bye, guys.
Thanks, everyone.
Bye-bye.